What if I told you everything that has been taught to you about long-term investing is a lie? That famous advice, just stay invested for the long term and you'll automatically make money, is actually destroying more wealth than it's actually creating. Today, I'm going to shatter this myth with hard data that financial industry doesn't want you to know. Here's a number that will shock you. In 2025, 91% of Indian retail traders lost money in futures and options trading. But wait, there's more. Each trader lost an average of 1,10,000 in just 1 year. Over 4 years, a mind-blowing 2,86,000 crores in combined loss. Now you're thinking, that's trading, not investing. But here's the uncomfortable truth. Even so-called long-term investors aren't safe. I'm about to show you why the stock market's biggest success stories had periods where investors were stuck for years, and how one moment of panic can actually destroy decades of supposed compounding. Think about this. We have all heard that stock market delivers 12 to 15% return if we just stayed invested long enough, right? But let me paint you the real picture. Take Nifty 50 for example. Over long periods, its returns have swung anywhere between 7 to 20% depending entirely on when you entered. Reliance Industry, over 20 years, it gave 13% CAGR. Sounds decent, right? But ask the investors who stayed stuck for years during its stagnation phases between 2008 and 2016. Infosys, the IT giant, managed just over 10% CAGR in the last decade, but invested endured multiple years of complete flat returns. By the way, I'm Nikhil. I'm a chartered accountant by profession with nearly 2 decades of experience with EY, PwC, and one of India's top wealth management firm before launching my own startup. And this is Finicky, where I simplify money the same way I practice it. Here's the biggest myth buster of all. That phrase you hear everywhere, time in the market beats timing the market. In other words, just stay invested for long term and you'll definitely make money. Let me show you why this is mathematically and psychologically impossible. Myth number 1, the 12% guaranteed return. The famous 12 to 15% long-term equity returns assumption is based on cherry-picked data from January 1995 using NSE 50 data and assuming you never missed a single monthly SIP. But here's the brutal reality. Even a 27-year investment period from 1919 to 2017 in Nifty 50 gave only 13.7% return. Myth number 2, time in the market beats timing the market. This popular phrase has cost investors quite a bit. While market timing is indeed difficult, blindly staying invested isn't the solution either. Studies show that missing just 10 best days of market can reduce your return by 50%. But here's what they conveniently forget to mention. Missing the worst 10 days can increase your returns by even more. The harsh truth? The time in the market strategy only works if you can psychologically handle 30 to 50% drawdowns without panicking. And research proves most people can't. Let's look at some case studies. Case study number 1 on Reliance Industry. Everyone talks about Reliance as India's safest long-term bet. Let's look at the numbers. 20 years CAGR 2006 to 2025, 13.3%. 10,000 invested in 2006 becomes 1,22,000 in 2025. Sounds impressive? But consider this, between 2008 and 2016, Reliance was stuck in a stagnation phase for years. Your money would have been underwater for extended periods while inflation silently eroded your purchasing power. Case study 2 on Infosys. The poster child of Indian IT seemed perfect for long-term wealth creation. 10 years return 2015 to 2025 is 168% absolute return. That's about 10.2% CAGR. 1 lakh became 2,68,000. But during IT slowdown from 2018 to 2020, the stock was flat for nearly 3 years. Many long-term investors sold during these periods, destroying their wealth before the eventual recovery. Remember the Harshad Mehta scam of 1992? The Sensex fell 50% in single year and it took decades for investors' confidence to return. Or think about DHFL, once considered a solid name, completely delisted in 2020, wiping out shareholders entirely. But it's not just Indian markets, even global legends prove that long-term investing isn't a magic wand. Warren Buffett, who famously said never lose money, has had many losing bets and today sits on a 325 billion cash pile. Not because patience guarantees return, but because even he knows timing and risk matters. Charlie Munger said, the big money is in the waiting. But he also admitted most fund managers live in denial. George Soros built his fortune on one principle: markets are always wrong. Even John Templeton, who averaged 15% growth year on year for last 38 years admitted that timing the market pessimism is almost impossible. By the way, if you're finding this useful, just hit the like button and subscribe. It's a small thing, but it really helps me know that you're actually enjoying this kind of video and keeps me motivated to make more for you all. Now here's where things get really interesting. Even if markets do their job, we often fail to do ours. And this is where behavioral finance becomes crucial. Losses hurt twice as much as gains feels good. That's why investors cling to bad stocks for too long and sell good stocks way too early. We often follow the herd, buy in euphoria and sell in panic. We get very overconfident, thinking we can actually outsmart the market only to fall into obvious traps. These psychological traps explain why even when mutual funds report 12% return, the average investor earns barely 6 to 7% because they enter too late and exit too early and sabotage their own wealth with their emotions. Every single guaranteed investment strategy eventually fails, and I can prove it. Value investing underperformed growth for the entire last decade. Index investing, though powerful, is creating cap-weighted bubble as everyone piles into the same few companies. Momentum investing works beautifully until violent reversals wipe out all the gains overnight. Ray Dalio's all-weather portfolio promised stability, but correlation spiked during crisis and the strategy struggled badly. Even Nassim Taleb's Black Swan protection keeps you safe from disasters, but at the cost of dragging your returns down with expensive insurance. The point is crystal clear. No strategy is bulletproof, markets evolve, and what worked yesterday will not always work tomorrow. This brings us to one of the most celebrated strategies in India today, SIPs. They are marketed as the holy grail for retail investors, almost like a set and forget formula. But let me bust this bubble too. SIPs only outperform in volatile and bearish markets, not always. In strong bull runs, lump sum investing always wins decisively. And here's the real kicker. Many investors panic when markets fall, stop their SIPs midway, and destroy the very compounding they were counting on. Plus, mutual fund returns are often overstated because of survivorship bias. The poor performers disappear quietly from advertisements, and only the success stories are promoted. Then comes the unpredictable shocks, what we call the black swan events. The crashes of the 1929, 2008 and the COVID-19 meltdown erased decades of gains in just few months. Closer to home, companies like BHFL, Yes Bank and Lakshmi Vilas Bank were once seen as solid, relatable, reliable names. They ended up wiping out shareholders' wealth entirely. And the constant threat of regulatory changes, sudden tax reforms or delisting risk, all it takes is one policy stroke and your so-called long-term advantage can disappear overnight. What's the point of waiting 20 years if a single event can reset your portfolio back to zero? So if long-term myth doesn't hold good, what does? The answer lies in what I call the adaptive intelligent investing, a strategy that combines systematic investing with flexibility. Picture this, 70% of your money goes into diversified index funds, but instead of holding them blindly, you rebalance based on market valuation. 20% stays flexible, you increase investments when markets are cheap and cut down when they look overheated. The remaining 10% is your risk money. Startups, crypto, small cap stocks, with clear understanding that this could go all to zero. You maintain a safety net of 12 to 18 months of expenses in cash. You diversify beyond India, spread risk globally. Most importantly, you keep emotions in check with clear rules on when to book profits and when to cut losses. This isn't about chasing every rally or sitting passively for decades. It's about staying disciplined while adapting to changing times. You must be wondering, why don't you hear this side of the story more often? The answer is simple and profit driven. The industry thrives on selling you the long-term dream. Mutual funds and brokers make money as long as you stay invested regardless of your returns. Survivorship bias hides failures. Market campaigns like Mutual Fund Sahi Hai simplify the story for mass adoption but conceal the complexities. Behavioral traps like fear, greed and overconfidence destroy more wealth than bear markets ever could. Here's the truth you need to take away. Long-term investing by itself is not a guarantee of success. Yes, markets grow over time. They also crash, stagnate and wipe out investors completely. Blind faith in just stay invested isn't a strategy, it's just a hope. And hope is not how wealth is built. What actually works is survival, adaptability, and disciplined investing. Ask yourself not just how much you can earn, but how much you can afford to lose. Don't measure success only in CAGR, but in how well you can navigate cycles, recover from shocks, and intelligently take profits off the table. Because at the end of the day, wealth isn't created sitting forever, it's created by staying alive through cycles, adapting when game changes, and being disciplined enough not to fall for myths. So, the next time someone tells you just hold long term and you'll be fine, remember this: your wealth deserves more than just blind faith. It deserves knowledge, discipline, and the courage to adapt. Comment below with your investment goals, and if you found this helpful and eye-opening, don't forget to share it with someone who also needs this reality check. That's it from me. I'm Nikhil Verghese. Share this video and subscribe to learn how to make your finances less tricky with Finicky.